Hey guys, Tank Sauce back again for another video, and this one we are going to be going over ranges and trends, right? Or trending markets, trends, and the ranges, and how you guys are able to maybe use some of those. So we just went over the session times, right? Well, within those sessions, there's also ranges that you want to take note on, right? And Asia, you guys will see the Asia range, which you can form trades off of, will form between 8 a.m. and, uh, oh, I'm sorry, 8 p.m. to 12 a.m., right? So you can, the range that forms between that time is going to be an important area. So here is that 8 and midnight is right here. So this will be the low of that. And when a lot of times the way you trade these ranges is the same way we went over the news range, right? You guys wait for one side to get taken and then you want it to trade to the other side. So London's range is between 2 a.m. and 5 a.m. So here is the low for London, and this is going to be the high. Let's change those to orange so they're easier to identify. And it's the same thing for these, right? We generally want to see one side of the range taken and then potentially trade to the other side, right? Or we take one side of the range, we'll retrace to 50% and then continue in the direction it was going. So when you're trading ranges, those are going to be your two ways, or there's really three ways to trade a range. And one way is you wait for one side to get taken. We come back into the range, right? And then we trade and take the other side of the range. That's one way to trade a range. The other way to trade a range is we'll come, we'll take one side of the range, we'll hold, and we use that side of the range, whether it's the top or bottom, right? We use it as support or resistance and then continue, okay? And the third way is we go on the range, we take one side of the range, we retrace to 50% of the range, and then we continue back in the direction that we were going, right? So those are the ways that you guys are going to see when you're trading ranges that things are going to happen. And in this, the New York AM range, obviously here was the low. The high went to 11, so this would be the high. Here on this one, we retraced back down into the discount of the range and then we continued up. On one of the other assets, there was one of the divergences, um, and which we talked about in the correlated assets. Uh, that, oh no, that's a future video. You guys will see it. Correlated assets divergence. One of the assets takes the top and the other one doesn't. And then we retrace down and then we continued up, right? So these are the times you guys have ranges you can use to trade off of. One of the other big ones that I like to use from time to time is going to be the lunch range, and I'll use it in the afternoon. And that's the range that forms between between 12 p.m. and 1 or 12 and 1:30, right? You guys can use either of those. And it's the same thing. We'll generally take one side, as you can see here, the 12 to 1. We took it, we came back up into range, and then we created it to the other side. So that's a specific setup I will use. Um, and you guys can form trades based off of these ranges, right? The New York PM range, so the one that forms from 2 to the close at 5. So this will be the low for the 2 to 5, and this will be the high. That range is generally used the next when market opens. So market closes right here on Friday at 5 o'clock basically, and we're going to open up right here Sunday at 6 p.m., right? Because it's closed end of day Friday, Saturday, and it opens back up Sunday. Here, we might be able to see price take the PM high and come back into range. And what will we do when that happens? Well, we're going to watch for it to come to 50%. or maybe we're going to watch for it to go all the way 100% of the range and continue down, right? So that is how we use ranges in our trading and the different things you want to look for when you have ranges that you're going to be trading off. So that's one of the first things you want to get familiar with. Um, the next thing I want to show you guys in this video is about trends and trending markets. So first, let's go to the daily time frame, and you guys can see on the daily we have been on a high time frame trend since back here in October of 2022. We've just been going up really, right? So we'll use this as our trend anchor, and we're going to put price up here like this. And no, it didn't quite. There we go. You can see that we're bouncing, we're bouncing, we're bouncing. Every time we come back and we hit this trend, here's a second one, right? A third one, we bounce and we keep continuing up higher. So we actually just came back to it again this past Friday. So right here, we can either expect one of two things. We're going to bounce here and continue up, or if a trend gets broken, like back here, you can maybe expect that price is going to continue down from there afterwards, right? So that's how we look at trending markets and trends. And that is right there, another uptrend market trending upwards or an uptrend. And when it gets broken, it comes down. So that's how you use trends. And it works going both directions. You guys can use the market trends going up, or you can use it going down. And when it gets broken from the downward, you can expect it potentially to go up afterwards, right? As you can see here, downtrend, it's broken, we continue up, and then we pick up on this uptrend. And one thing to note about the charts is that the same thing happens on all time frames, right? So trends that happen on the daily time frame, they also happen, say, on the hour time frame, right? So here's the hour, and we have a lot more trends because what was I saying? That the lower in the time frame you go, the more noisy it gets, right? So here we go. We have a few uptrend here. It's broken. Well, we gapped down here, but it comes down. Uptrend here. You can see we touched it a bunch of ways, go on the way up, and when it gets broken, we dumped, right? This would also be a downtrend, a very steep downtrend. And as soon as it's broken, we started coming up. Again, with the uptrend, broke coming down, downtrend right here, it gets broken and it comes up. So those are two basic things in trading that you guys can use and pay attention to. You will hear us talking about ranges. You will hear us talking about Asia ranges, London ranges, New York ranges, lunch range. These are going to be terms that you guys hear a lot. So it's good to know what they are and how we use them, right? There's also other ranges you can have in trading. Like you can have the range on the leg of price. So this is a range right here from this high to this low, and I'll use my range Fibonacci for that, right? So those are some other ways that you guys are able to go. Um, you guys are able to understand if we say the 1 hour range, we're generally going to be talking about a range formed on the 1 hour in one price leg, right? And one price leg of movement right here. So those are the different types of ranges you guys have. There's also other ranges like the opening range breakout, which is a 15-minute range generally, and that's the 15 minutes of the market, and that's denoted right here from at 9:30 a.m. on the 15-minute time frame. And generally, if price breaks out of one side, you want to see it continue in that way, right? And here we did come back down to retest the 50% of that range and then continue upwards. And if price goes in and fails and immediately reverses, you can maybe expect it to go the opposite way. So those are going to be some ways that we use ranges and trend lines in our trading. And of course, you guys are going to have to learn more once you guys pick the exact strategy that you guys are going to use and incorporate these things. But when you hear us talking about different ranges and trends, etc., these are the things we're going to be talking about. See you in the next video. Okay, guys, so I actually ended the last video and then realized that I needed to talk about a little bit more on the ranges because this is something that kind of applies to ranges, and that is the Fibonacci, right? What is the Fibonacci? Well, the Fibonacci is a mathematical tool of measurement that we use in our trading. And if we have a range, like right here, we have this set range, right? We'll call the high of the range premium and the low of the range discount, right? That means we're in a discount. This means we're in a premium. If we drop like this, we use the Fibonacci to show us where 50% is, right? If we're going to take more shorts, say we caught this short right here, we got the whole thing, we're super stoked, we made a ton of money, life is great, and it bounces here and comes up, we don't generally want to take another trade or another short until price reaches at least 50%, right? That's going to be our first area to look at and consider more shorts. And in one of the next videos, I'm going to show you guys about FVGs in this next coming one. But here we have an FVG, which is a gap in price, which I'll explain later. And that FVG falls right at 50%. We hit it. We keep our close of the bodies perfectly below the 50% of the FVG. And then we continue downwards from here, right? So this Fibonacci is a tool that you guys are going to be using in your trading to measure certain mathematical retracement points of ranges, right, when you're trading, because each of these that we have marked mean a different thing, and those are going to be for more advanced videos, but this is basically going to be showing you guys what the Fibonacci is and how to use it. So this is how we use the fib on a range. We want to have 50% so it can tell us when price is back into a premium if we're going down, and if it's price that's going up, which we've been coming down for a minute, but if price is going up, right, we want to mark when price gets back down to a discount, right? Let's use this range right here because that was an ugly one. Here's this range. You could see price comes back down into a discount. Here was the low that created this high. We had a little retracement here, but even that one you can see in the range. Price nicely came down to 50% before it continued. But here on this one, we come up, we retrace down into a discount before we continue up, right, for more longs. So the Fibonacci is a tool that you guys are going to be using when you measure your ranges. And it's also a tool that you can use to gauge how far price might go, right? And we'll have to do this and get more into it in another video because it's a little bit more advanced. But on the fib, you can take the manipulation leg of price and you can figure out where price is going based off that. And generally, when you have a manipulation leg, you use the Fibonacci to get projections, and you want to see price run to the 2.5 deviation. So if you trade off manipulation legs, which that's what this was, right? Because we came up here, we chopped around a little bit, we dipped down, we took this low, which is the manipulation leg, and then we continued up from there, right? Um, so that's how you can use the Fibonacci. So when you hear us saying fib, no one really ever says the whole thing. We'll say fib, it's abbreviated. We're talking about this right here.